CMS Info Systems Limited Q1FY24 earnings conference call hosted by IIFL Securities Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Balaji Subramanian from IIFL Securities. Thank you, and over to you, sir.
Thank you, Neerav. Ladies and gentlemen, good day, and thank you for joining us on the post-results conference call of CMS Info Systems Limited. It's my pleasure to introduce the senior management team of CMS, who are here with us today to discuss the results. We have with us Mr. Rajiv Kaul, Executive Vice Chairman and CEO, Whole-Time Director, Mr. Pankaj Khandelwal, President and CFO, Mr. Anush Raghavan, President, Cash Management, and Mr. Manjunath Rao, President, Managed Services. We will begin the call with opening remarks by the management team, and after that, we will open the call for a Q&A session. I would now like to hand over the call to Mr. Rajiv Kaul to take proceedings forward. Thank you, and over to you, Rajiv.
Thank you, Balaji. Good afternoon, everyone. Thank you for taking the time to attend our Q1FY24 call. We have most of us have recently interacted at our Investor Day on May 25th. This call is going to specifically focus on our Q1FY24 results. We continue to deliver consistent growth with revenue growth of 13% and adjusted PAT growth of 20% in the quarter. We're happy that this is our fifth consecutive quarter with 20% year-on-year PAT growth. This is also a quarter where we hit the 500 crore revenue mark for our services revenue for the first time. Q1 is usually a seasonally weak quarter. Despite that, we have managed to grow on all of our key metrics. Our CFO, Pankaj, will now take us through the financial highlights.
Thank you, Rajiv. Good afternoon, everyone. Our consolidated revenue has grown by 13% to 512 crore, with managed services and technology solutions now contributing around 36% to overall revenue. Our adjusted EBITDA has grown 19% to 152 crore, and our adjusted EBITDA margin profile is now 29.6%, a year-on-year improvement of 160 basis points. Our adjusted PAT has grown by 22% to 87 crore, making this 9th out of 10 quarters for 20% plus PAT growth. These numbers are testimony to our market leadership and execution of our order book won over the last year. Both of our business segments have delivered strong results. I now hand over the call to Anush Raghavan, President of our Cash Logistics business, for more insight into the business performance.
Thank you, Pankaj. Good afternoon, everybody. Our Cash Logistics business revenue has grown by 12% year-on-year to 351 crores in the first quarter, with an EBIT growth of 22% to 94 crores. The EBIT margin has further expanded by 218 basis points year-on-year to 28.6% in this quarter. In May, we had released our first cash vibrancy report, which is the first ever report on cash usage trends in India, which highlighted the robust cash usage across geographies and sectors. We continue to see strong usage trends in currency in this first quarter. Our network had the highest ever currency throughput of 3.3 lakh crores. We also continue to see the trend of currency usage growing in metros by 10% year-on-year, outpacing the growth in semi-urban and rural India. Our business network has further expanded in this quarter, and we currently service 126,000 business points, a 10% year-on-year growth. On the company front, we are seeing a strong momentum in cassette swap implementation. This has been reinforced by the regulator's push and an industry-wide consensus. We are now targeting a one-third cassette swap compliance of ATMs by the end of FY24. With that, I now request my colleague Manjunath Rao to share with you an update on the managed services and tech solutions business.
Thank you, Anush. Our managed services and tech solutions business revenue has grown 17% year-on-year to INR 182 crores in Q1, with EBIT growth of 15% to INR 34 crores. Our EBIT margins stood at 18.7% in the quarter. We have successfully completed the execution of ATM managed services of 5,200 ATMs for a large public sector banks across 526 cities and towns in 26 states. In our AIoT remote monitoring business, we are investing in building AI modules and are conducting pilots in other verticals. In this year, we expect to see key large PSU RFPs for both automation and ATM as a service business lines. Just to close out, we reiterate our FY25 revenue target of INR 2,500 to 2,700 crores. Thank you for your support and attending this call. We can now move to the Q&A.
Thank you very much. We'll now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. Participants, you may press star and one to ask the question. The first question is from the line of Varun Darji, individual investor. Please go ahead.
Thank you for the opportunity and congratulations on the wonderful set of numbers. Sir, I wanted to ask a couple of questions. Thank you, first of all, for the very detailed transcript that was shared on the exchange website. So while I know the call is specifically for the Q1 results, I had a few questions around the business, right? You had mentioned that 40% of the ATMs are still being serviced by banks, while 60% is being outsourced to players like CMS, right? So how do you see the roadmap going forward for this existing 40% which is managed by banks and the incremental one that banks will deploy in, let's say, 2 to 5 years of time? What is the trend directionally that you see? Secondly, on the trade receivable numbers as well, the trade receivable numbers is 451 crores as of March 2023. That's broadly in that range for the last 2-3 years, right? I was just curious to understand why is that number so high? Is that something that is peculiar to the industry? Would that number be very similar for your competitors as well? Thank you.
Well, hi, this is Anush here. I'll take the first part and Pankaj will answer your second part of the question. As far as the outsourcing trend is concerned, and we've sort of shared this in some of our previous calls as well, this is a longer term trend. 8-10 years back, perhaps, there was a greater majority of ATMs which the banks were servicing themselves as opposed to what they were outsourcing. With each new iteration of RFP and the outsourcing process, there's a greater percentage of ATMs which banks choose to outsource. It's really a function of what is the comfort and the sort of quality of outsourcing, sophistication of that, which is being adopted by the banks, number one. Second, a lot of these ATMs which are serviced by the banks themselves are typically on-site branch ATMs, which is the public sector banks. So private sector banks are almost completely outsourced their ATMs. And now as incrementally the public sector banks are getting comfortable with moving to an end-to-end outsourcing project, we are seeing a greater number of ATMs which are coming, which used to be branch managed, moving to outsource. But this will still take time. This will still take a few years for this trend to continue. And what used to be 50% earlier has become 60%, and we expect this to keep inching upwards. Okay.
Yeah. On the trade receivable, one is that we don't comment on our competitors. As regards CMS is concerned, if you see the FY21 to 23, there is around 25 days DSO improvement.
Okay, understood. And sir, as of June 30, 2023, how many ATMs would CMS mention? I think the last time that number was 72,000, right? What would be that number as of 30th June 2023? And what do you think the number 2 and number 3 players, of course, without putting in a name, how much would they be managing?
So as far as the second part is concerned, Varun, sorry, can't really help you with that. But we also, had mentioned this again in some of our earlier calls. As far as the detailed breakup of the business-wise statistics are concerned, we would prefer to share that on an annual basis. A quarterly frequency is not really appropriate. So what we do report on a quarterly KPI basis are more the consolidated business points.
Okay, thank you. Very helpful. I'll rejoin the question queue as I have a few more questions. Thank you.
Thank you. Next question is from the line of Prithvish Uppal from Asian Market Securities. Please go ahead.
Yeah, thank you for taking my question and congratulations on a really good performance. Couple of questions. First, I just wanted to understand the roadmap of the managed services business as well as in particular the AIoT business. How do you see that scaling up into the ambition of doubling the FY21 revenue by FY25? So how are we positioning specifically the AIoT business in terms of ancillary, like you spoke of certain pilot projects? So what has been the feedback there? And in terms of increasing the number of touch points that we have in that business as well, how do how are we perceived vis-a-vis the competition? So that would be the first part of the question. Second is if you could possibly give a breakup of even FY23 the split of the cash management business within the ATM cash management, the cash in transit, and the retail cash management business. That would be would be helpful. And thirdly, in terms of the we've been even cash flow wise, operating cash flow has been growing quite healthily. So just wanted to understand what are the uses of the cash that we are earmarking specifically in terms of growth. So where are we seeing investment opportunities going ahead? So these would be my three questions.
Thank you, Prithvi. I'll take this is Manjunath. I'll take the question on your remote monitoring services. As you know, our remote monitoring services was launched in 2021, which is now at an annual run rate of about 100 crores, and is also the largest in the BFSI sector. We already have about 20,000 sites plus live and we are further investing in AI modules for new cases. And our overall MS and tech business has scaled to greater than 35% of the revenue. We are aiming for our RMS and software business to be about 8 to 10% of our revenue by FY27. Does that answer your question?
I think that's the first one.
Yeah, understood. So, 8 to 10% by FY27 is what we will be targeting in terms of the remote monitoring business.
Yes.
Okay.
Remote monitoring and our
software businesses. The tech business.
Okay. And this does not include the AIoT? Oh, sorry, this is just the AIoT business.
This is the AIoT. Sorry, go ahead.
Okay. The second question was around cash on books. On cash, I think from an M&A perspective, we have not M&A. I think just from a cash on books over the last 2 years, Pankaj, we've invested how much money for capex?
So 350 crore for the growth capex.
Yeah.
And we are
100 crores of maintenance capex, roughly. So we've invested about 420 crores of cash in the last 2 years for both growth and maintenance capex. And we have given a general direction that this year capital spend could be in the 150 to 175 crore range, which would include both expansion into adjacencies in growth capital for new wins we have, and some maintenance capex and upgradation of our network. I think there was one more question which if you can just repeat.
Yeah. So
I think we don't give a breakup of sub-segment wise split. I think that's what we have and what we share is broadly between our cash business and the MS, and within each businesses, then we don't give a detailed breakup.
Okay, because my perspective actually was for asking that was specifically in terms of retail cash management and the opportunity. Because last couple of years, the growth rate would have probably been slightly on the lower end because of, the COVID and pandemic-related disruption. So, just some color in terms of how we're seeing specifically the retail cash management business growing, both in terms of touch points, pricing, and, just some color on that.
Okay, I can try and help you with some of that, Prithvi. I think, during our investor call, we had shared some March end statistic, which is a split of our business points by ATM and retail, which is roughly about 72,000 ATMs and about 52,000 retail touchpoints. That will give you a sense of what that, at least the business point split is not, it's not on the revenue. As far as retail is concerned, if you look back the last few years, a lot of our growth has been powered by the growth of the ATM network in the country, as well as incremental outsourcing. And as we've alluded to it, that trend will continue into the mid to long term, especially as banks seek to increase their footprint and also get into further end-to-end outsourcing. In addition to that, we are now seeing a strong, aggressive intent on part of large organized retail formats to expand their footprint in the country. As we are recovering from the whole COVID impact and as consumer spending is coming back, a lot of them have both publicly and in our conversations alluded to wanting to expand and open up, especially on the physical infrastructure side. Even people who are running so far very digital businesses are very keen to get into physical side. So I think when we think of it and we look at this from a mid to long term perspective, which is from a 5 to 10 year story, I think the retail and the growth of retail, the growth of consumption, and the growth of and all of that will have a significant tailwind into how it feeds into our business growth.
Okay. Understood. Okay. Yeah, that's it from my side for now. All the best. And if there are further questions, I'll join back in the queue.
Thank you. Next question is from the line of Pujan Shah from Consortium Investment Advisors. Please go ahead.
Hi, sir. A few questions from my side. First question would be, as we have said that the 40% of the ATMs have not been still coming out from the banks like managed by the bank. So are there any restrictions, or it has been like how I'm not able to understand that why it is been so slow from the bank side, because all banks wanted to be an asset light or like that. So what could be the reason for that specific?
So I think if I understood your question right, you're asking why are 40% of ATMs even managed by the banks themselves. So I think earlier, if you look at it, the banks used to only enter into pure managed services contracts for a fixed fee basis, not end-to-end outsourcing contracts. As a result of which, the public sector banks especially found it convenient to continue managing the branch or the on-site ATMs themselves and outsource the off-premises, off-site ATMs to managed service providers. That trend is changing as the public sector banks are getting more comfortable moving to end-to-end outsourcing. As and when those RFPs come up, those ATMs which are managed by the branches switch into an outsourcing model.
Okay, got it. And sir, have you announced that we will deploy some 150-175 odd crores of capital into expansion plus maintenance? So if we look at our historical capital flow, we have invested 70 crores for the maintenance for last trajectory. Now, if we consider that cost, so are we have any plan for the M&A specific which we have been eyeing to and we are trying to acquiring, or any deal flow is going on specific for that?
So the capital plan which we have indicated to our investors or at both the investor day and today is mostly for our growth and maintenance capex. This does not include. It's very difficult to predict what will be the spend for M&A. I think that will be specific to the opportunity. As and when we have anything to report on M&A, we will come and update you for sure. And
okay.
Maintenance capex, I think the ratios should remain the same as you've seen in the last 2 years. Our CFO shared with you, we have spent about 420 crores, out of which roughly about 70 crores would have been in maintenance capex. So similar ratios should continue for this year.
So major capex would be go for the BLA side because we have been deploying that capital?
No, I think it is not for I think when you think about our growth capex, it is towards the order book, it's towards our business lines, both in AIoT, ATM as a service, which you are talking about, and also investment in fleet upgradation for our network and for RBI compliance. It will be a combination of these things. And also from the investments is going into incubating some of the new business lines we have shared at that Investor Day. And finally, for implementing the work we are doing in the technology side.
Okay.
It's across the whole spectrum of things.
Okay. And the current order book, as we have seen, I have seen that 150 crore is from the managed service. So total order book size, if you can spell it out.
It's 3,300 crores.
So we report order book for our managed services business only, specifically for that business. And our cumulative order book over the last 2.5 years, there is now at 3,300 crores. 150 crores was the addition to the order book in Q1 of this year.
Okay. And how much would the order book has been completed over this accumulated order book?
90%.
90%. Okay. Okay. And last question would be on my side would be, have we faced any union-related issue? Because in DISP, I have read somewhere that we are facing we have faced in the historical that we have faced 17, 18 issues related to the union base due to employee-related service, and we have also been closed out our Kolkata services in some of the parts. So have we faced the similar situation in the previous 2 years?
No, we're not. No, but those have been more once in a very rare occurrence situations. But having said that, union entering into collective bargaining agreements, having long-term settlements with unions is sort of part and parcel of our business. But we've not had any such situations in the last 2 years.
Okay, got it. Thank you so much, sir.
Thank you. Next question is from the line of Pratik Chheda from Guardian Capital Partners. Please go ahead.
Yeah, thanks for taking my question. So my question pertains to the cash management business. In this business, on a QOQ basis, we've been seeing consistent growth of around 2 to 5% every quarter for the last 6-7 quarters. But this quarter is sort of flat. So just wanted to understand, is there any one-off, is there any delay in some execution of the projects?
So, Pratik, in our cash business, usually has a Q1 which is seasonally a weaker quarter. Last year Q1 we didn't see that trend simply because the year-on-year was also linked to pre-COVID time. So I think Q1 is something we do see usually a dip basis Q4. Still the cash business has had the same revenue as in Q4, which is I think pretty good. There are some ups and downs which happen in business on a quarterly basis, but nothing significant which will have a material impact.
Got it. Second question I want to understand is on the margins front. Now, on the cash management business, we've reached EBIT margins of close to around 26.8, so around 27%. Now, are these banks coming back and sort of sitting on a table and renegotiating pricing with you, or how are you thinking about EBIT margins going forward? Have we reached a peak, or is there any further improvement which can come in through operating efficiency or through pricing?
So, as you've known us for some time now, we don't comment on margins. I think for the team to manage and balance our goals on revenue growth, margin and market share is something which we are to keep working on every quarter. From a perspective of bargaining and negotiation, I think that is part and parcel of every B2B business. What you have to, you and other investors will appreciate that what we have is a network density business, where margins are blended over multiple customers and multiple business lines, and we do run a route network, which is not very easy to either replicate or to disaggregate. A significant part of the margin improvement in the last 2 to 3 years has also been with respect to growth in the network as well as automation efforts. So while we don't have any guarantee on margins maintaining themselves at the current rate, I think as a team we've been very focused on trying to maintain a superior margin profile to the rest of the industry. And our large market share and our market infrastructure helps us achieve that.
Sure. Thank you very much.
Thank you. Participants, you may press star and 1 to ask a question. Next question is from the line of Amarnath Bhakta from Ministry of Finance, Oman. Please go ahead.
Yeah, it's Amarnath Bhakta actually. Am I audible?
Yes, we can hear you.
Am I audible?
So you're sounding slightly distant. If you can come a little closer towards the speak.
Yeah, okay. Actually, my first question is relating to this promoter stake sale. If we look at from December 2021 up to now, the promoter stake is continuously getting reduced, and recently there was a promoter sale, which is of course bought by somebody else. What is the reason? If the management was so strong, the outlook is so strong, what is the reason of this continuous promoter stakes reduction?
So, if you look at a promoter of CMS, our promoter is Cyan Holdings. Cyan Holdings is a company out of Singapore, which is in turn owned an investee company of Bearing Equity Partners in Asia, which is a large PE firm in Asia. Bearing and their holding company Cyan have been investors in CMS for over 7 years. And as part of their own exit process, they will look at exiting their stakes in investee companies. So you should think of this as a financial investor and not a strategic investor. And the financial investors will have their own timelines and plans for exiting stakes and reducing them. In fact, many other investors have been keen to know as to how does the promoter stake go down, because they feel this has so that the stock can be more widely held among institutions.
Yeah, so that means we can expect a further selling from this Q1 investment in the future time to come?
Yeah, I mean, logically, yes. I mean, but, we as a team obviously will not have insight or won't be able to comment on what Cyan's plans may be. But logically, if you look at the trend of any PE shareholder, the stake they would look at exiting the stake over a period of time.
Oh, okay. The second question is a little bit on a strategy side. See, as you say, the opportunity size for the cash management is increasing, but on the other side, if we track the government different announcement, the government is continuously emphasizing for a cash reduction or cash-less transactions, and accordingly, the UPI-related transactions are getting prominence every month, and the transaction happening there is just booming. So in that context, I'm just trying to understand, though the country like India, we know it cannot be a completely cashless because of our demography, but the growth what you are projecting from the cash management services vis-a-vis the current trend of the huge growth in the UPI transaction, how these two are going side by side. If I assume that UPI will take more prominence, which will be the case, will it not be affecting your cash management business going forward?
Yeah, so I think one of a helpful background read to this in a more detailed manner would be, we published and during our annual event on May 25th, we published a very detailed report, which was the cash vibrancy report, which sought to try and explain, using as much of our data as possible, where is currency coming from and where is it being spent in the country, and what are some of the more longer-term trends around that. So it's available on the website, so it might help to.
Yeah, I have seen that, sir.
Sure.
Actually, I have seen in detail. The question is coming that whatever data has been presented, to be very frank, in that mail is mostly depending on the past data. The future, I'm talking about the way the UPI is getting acceptable, even at the very lowest strata of the economy, including the Vajiwala and Chaiwala and all. And even we can see in our day-to-day transactions, our frequency to go to ATM to withdraw the cash or deposit the cash has substantially come down compared to what it was. I'm looking to the futuristic part. How do you give the kind of a confidence to the investor that this is not going to impact your cash management business substantially?
Well, I think it's a fair point, and we think of it from a few prisms. One, what are we betting on here? We're betting on the fact that our growth, and when you think of CMS, you should think of it as an integrated platform for both cash logistics and managed services and AI remote monitoring. We serve banks. We help banks cut down their costs and managing their infrastructure better and cheaper. Some part of that revenue is from cash logistics areas, which is now 2/3 of our revenue. We feel there is a lot of opportunity in the coming 5 to 7 years, which will come from organic growth, which will be slower than before for sure, but with higher outsourcing from banks, I think that should compensate. Then you drill down into specific sectors like retail, where we feel that more formalization basis GST and more organized retail forming in India will create an opportunity for retail cash management business to grow much faster than other cash logistic areas. That gives us the opportunity for growth. The third has been our entire expansion into technology-related services. What we have done in managed services, in banking automation, and then AI remote monitoring, which was all of these were 0% of revenue in FY16, and now are 34, 35, 36% of our revenue. So we look at expanding our business lines into where we can add value to customers, and we look at that as a way to grow. Now, we think of it, yes, we are talking about the past, but that's the only data we have. We don't have forward data. We do think that India, there's a lot of potential for, I would say, informal cash to move to organized cash, where it comes into a banking system. When 2,000 rupee notes come back into the banking system, there is a velocity and a transaction opportunity for people to deposit and then to withdraw again. Yes, we do see UPI-led payments growing rapidly, but I think the whole digital payments is something is not a one-year phenomenon. We've seen that from 2016-17 onwards. Their growth rates have moderated. But the nature of the digital payments, they will grow at faster than cash. But we've also seen cash growing fairly healthily and very robust numbers.
Yeah, thank you for this detailed explanation. Just one more thing. Regarding this IoT, AI and IoT related things, at the moment, I think you are doing only for this ATM part, the security, the physical replacement of the physical security by this digital security. Is it possible to extend this business segment outside the ATM to other segments of the business, means in retail or somewhere? Because this is the innovation product or innovative product you guys have started, and probably you are one of the first mover in doing this. So I'm just trying to extrapolate: is this possibly can go beyond ATM in some point of time in future, or the business is restricted towards the ATM centers only?
Thank you, sir. In my earlier introduction, I did mention that we are investing in AI modules to expand into other sectors. ATM was the low-hanging fruit. We moved in, and we have set ourselves very well. And we also have done many bank branches, and due to the recent MHA guideline for the financial services branches as well as for the NBFC sectors, there is an increased interest in the branch security systems. So that's a new area. There's a lot of interest and it's growing. But we also set up a lot of use cases, piloting in hospitality, in pharma industries. So there is a lot of things going on at this moment, and we are incubating new businesses and new lines in this remote monitoring services.
Yeah, okay. And my last question, sir, if you may please allow. With respect to you are saying that, yeah, just one more. What is your current market share at the moment? You are saying you are the market leader in the cash management and the retail management. Exactly what is your market share? Do you have the data?
I think if you look at it, there are different parts of the cash business. There is the ATM cash management. We also do retail, and then there is CIT. Each of those would have different market structures and will have different shares. But on the whole, if you look at our cash revenues, we'll be at roughly 40% plus revenue share of the overall cash market.
And that other side of the business, wherever you were saying that you are the number one?
So in AIoT remote monitoring, we are number one. I don't know our market share there because a lot of this ATM market is still in transition to moving to the new technology standards. We would estimate we would be at least 25%. I actually don't. Let me not give you a number off the cuff, but we are the highest number of installed sites there right now compared to anybody else.
Thank you. The next question is from the line of Akshat Haria from Multi-Act Equity PMS. Please go ahead.
Thanks. This is Darshan Shah from Multi-Act. I have two questions. One is, can you elaborate on the nature of cash losses that we report and how it is accounted in the income statement, as there are multiple line items? And second is, when we look at cash loss percentage in the ATM business versus retail cash management, there is a significant difference between the two. So can you elaborate on the what is leading to such big difference?
So there is two types of cash losses. One is that the cash losses in transit or the larger infidelity, wherein whatever the difference what we get from the insurance claim and the total loss, we should book as a cash loss in transit. The rest of the claims which are the smaller in nature or the reconciliation losses, that is part and parcel of our AR provisioning. So if you will see in any of our financial, there is a three line items you will see. The one is that cash loss in transit, second one is the bad debt, and third one is the provision for doubtful debts.
Okay, so this provision relates to reconciliation difference, provision and bad debts.
Yes. Doubtful.
Okay. But when we look at it as a percentage of revenue, this number looks very significant. And even as a percentage of, let's say, cash handled, it's very high when we compare it with retail cash management. So we are unable to figure out what is leading to such high numbers.
So Anush can maybe tell you a little bit nuance between the ATM and retail side of the business and processes and what is the difference. Maybe that will help you understand this.
See, one is that whatever the value of the currency we handle, like last year we handled 13 lakh crore rupees. In comparison to that, whatever the provision we have made of losses is insignificant, very difficult to calculate that. But generally, if I will calculate on the percentage of our revenue, it is coming to around 5% of our revenue.
Yeah, I think as far as the ATM versus retail is concerned, while I'm sure we don't break down the numbers by our business lines, so you might be comparing it to other people, but we don't know what is the exact accounting that people apply. But generally speaking, ultimately both ATM and retail have a very strong element of risk management to them. Structurally, when you look at it, whether globally or in India, the ATM business or ATM cash logistics by itself has a slightly higher degree of risk cost because of the nature of the business, which is we are responsible for the safe logistics of the currency from the bank to our vault, the processing of this money. You put that money into an ATM, and then there is also the fidelity risk of the cash while it is at an ATM. Second, there is also what used to be known as what Pankaj was trying to explain as reconciliation differences, or what the industry sometimes call chargebacks. These are those transactions for which customers who make a transaction at an ATM and sometimes do not receive the cash make a claim on the bank. So a lot of that processing a lot of those claims need to be processed and settled with the bank. So ATM by itself is operationally a very different type of work. It is a lot more intensive. It involves a greater degree of risk, and a lot of that is reflected into the pricing and the realizations that people are either pricing for it or charging for that. The difference in the retail cash operation is, the reconciliation happens almost on a daily basis because you pick up money from a retail location, you process it, and then you submit it to a bank. It's almost sort of instantaneous. Second, the ticket sizes or the values at risk in terms of exposure are a little lesser in terms of what one typically deals with at an ATM. But having said that, the nature of cash and transit exposure is reasonably similar for both.
Okay, thanks. That's it from my side.
Thank you. Next question is from the line of Asim from DAM Capital Advisors. Please go ahead.
Hey, hi Rajiv and team. So my question is more hypothetical. I wanted to hear your thoughts on this. So ever since RBI compliance norms started to get implemented, it became a more level playing field for larger players, and so industry consolidation began in favor of the big guys. At the same time, the TAM, even if I just look at the ATM, RCM, CIT, and maybe the BLAs put together, it looks quite lucrative per se. Plus, at least your margin and return ratios are also fantastic, but enough to attract attention of competitors. So my question is, what stops a well-capitalized player to enter this space? They may not have the margin that you have given the network density for now, but if they do come in, then what does that do to industry pricing, at least in the short term? Second, is there space for another player to coexist with the larger guys? And third, will banks work with a new player who might be open-minded on pricing as it has happened in the past? Or would banks also stick with larger guys given the network and penetration of you guys?
So Asim, let me try and give you perspective. And, you want to keep in mind that over the last 6 months, we have been highlighting that the market is attractive, is growing well with compliance norms kicking in. It becomes an attractive country and segment for large Indian multinational competitors, new companies to think about, right? I don't think there is any two ways to think about it. I think it is an attractive market and can attract competition. And we have been alluding to the fact that we may see more competitive intensity in the coming year or two. Coming to the second point about what prevent, so I think anybody new who wants to get into this business, and not just new, if you look at the history of the sector, there have been companies which have vacated a couple of the subsectors because it became unviable for them. They could launch back operations. There's nothing to stop them from trying to launch back operations. Now, building that scale, building the capacity, and trying to then run that network at a high quality basis over time, yes, it is possible. What impact can it have on pricing? That I think is very difficult scenario for me to really give you an answer on. People can enter the segment and give a discount to get business. We feel that in this, if there is a churn like that, there will be churn between the current 3.5 players, where share should start switching from, let's say, a lower quality player, whoever that may be, or in whichever geography that may be. Sometimes there are people who have respective strengths in respective geographies. And it may move to a little bit to a newer player or a new, hypothetically a new multinational company wants to come into India because they think the compliance norms make it now worthwhile for them. So that's what we could foresee. I'm sure share will shift between companies at that time. Will it move from the strongest and the largest to this company, or will it move from a weaker player to this? I think that is a scenario we'll have to wait and see when it actually happens. The second thing I think I want to clarify is that this is a scenario which is possible specifically, I guess, for the ATM side, which is where the compliance rollout is more ahead of the other sectors.
Okay. But still, I think the one line point, if I can take it is competition can and will most likely come in, but at least the larger guys have the moats already in place, so they should be ideally least affected at least in the medium term.
I mean, yes, but again, like I said, this is hypothetical, and we'll have to see when these things pan out what our response would be. But we have maintained that as a market share leader in the sector, we will have to be flexible and agile to balance our market share with our goals on revenue and profit. I think we've done a splendid job of managing and balancing these three, but every quarter is not possible to do this. And if there is a threat to market share, we will, of course, have to be very aggressive at that time.
Sure. And the second question is on BLAs. So at least on the ATM cash management side, you have 72,000 ATMs right now. I presume on BLA you would be maybe 10% or maybe a little less or more than 10% of those 72,000. Is there any rough percentage number of your ATM that you would want to be in BLA form in the future? Say maybe 40%, 50%, where at least the EBIT margins overall and return ratios remain healthy. And also, like the 8 to 10% revenue goal for remote monitoring that you have said by FY27, is there a similar revenue percentage goal in mind for BLAs as well?
So I won't comment on our current unit numbers for this quarter. I think we'll stick to the numbers we guided for in FY23 end. What we've said, Asim, both during IPO time and after IPO time is that we aim to keep our exposure in some way to the ATM as a service, which is the BLA business, to about 15% of revenue. We were at the end of FY23 at about 5,000 odd ATMs in that business. We are very focused in this business on very specific banks to work with. We are not a broad market player. We are a niche market player focusing on a few banks to work with. The broader BLA market in India, our estimate is about 90,000 odd, out of which we'll be doing about 5,500 odd right now. If there is anything which comes up for a bid or for a project which meets our return metrics, we'll of course we should be a good player given our integrated offerings to be able to bid for it. But given the nature of the business, the capital intensity, and these are long-term projects, we as a team would like to size this to about 15% of our revenue streams.
Okay, sure. Thanks a lot.
Thank you. Next question is from the line of Pranav Mehta from Valquist Investment Advisors. Please go ahead.
Yeah. Hi, sir. Thanks for this opportunity. So a couple of questions. So if we look at the revenue growth for this quarter at around 13%, seems a tad lower than the average of, say, around 20-odd% that we have been doing since the last couple of years. So just wanted your thoughts on what has led to this kind of number. And secondly, slightly longer term question on our margin profile. So we have been able to improve our margin significantly in the last couple of years, and the reasons are well articulated. But now as we move towards the FY25 target of, say, 2,600 crore revenue, how do you see the margin profile moving in the next couple of years at that scale? So these are my two questions. Thank you.
Pranav, I think for your first question, the problem for having very strong performance in the last couple of years at 20% plus is that expectations get built into that. But if you think from our perspective, right from IPO time, we have guided towards the FY25 revenue goal, which is what we are focused on, which is a revenue of 25 to 2,700 crores. If you look at our last year number of 1,915 odd crores, we are still guiding towards achieving that target in FY25. That will mean a 15-16% growth average for the FY24-25. Q1 at 13%, I would not read too much into this. I think Q1 is usually, as I said, has a seasonally weaker quarter. We have still done reasonably well, but we have to see what we are reading in the commentary of other quarterly earnings basis, retail and consumption and inflation and spend. We hope that growth continues in consumers, because that will be important for our both ATM withdrawals and retail business in the coming quarters. One quarter is too early to start commenting on. I think we gave a fairly detailed presentation at the investor update. Maybe in the coming quarters, at the end of H1, we'll have a better sense of how the year is moving from a macroeconomic perspective and specifically for our business. But as of now, I think we are in line to achieve our FY25 revenue target. Margins we have not guided towards at all. We have no margin guidance at all, and we will refrain from giving any margin guidance.
Sure. Thanks a lot.
Thank you. Next question is from the line of Weber from BNB Investment Management. Please go ahead.
Hi, am I audible? Hello?
Yes, you are.
Yeah, my question is regarding, since in the previous questions you answered that even if the advent of the UPI transaction, if the revenue will somehow be lower, then the revenue will be compensated by the other adjacent area you are operating in. But traditionally, as it's been seen that the management service part of your business is a little high capex intensive than the cash logistics. So can we expect that the return ratio will be lower if the contribution from the managed service will increase in the revenue part?
So, I would like to point out a couple of things here. One, our revenue CAGR since inception in 2009 till now has been 17%, through good and bad years, right? So it's a fairly high growth rate which a team and company has maintained through ups and downs of the macro and the sector itself. Coming specifically to your question on the capital intensity in some parts of our managed services businesses, I think what you should look at is if you look at our ROE numbers, our ROE has consistently increased over the last 3 to 4 years. Despite peak capex in the last 2 years, our ROEs went from 20 to 21% in FY22 to FY23. What is happening is the fact that orders don't always come separately by segment. Increasingly, a large bank will outsource end-to-end, and that component of the order will have many elements of our services. Some will have all our services, some will have some of our services. And therefore, margins will sort of blend across these revenue lines for us. So you already see the trend line in revenue and managed services, but you also have to keep in mind when you see a managed services EBIT margin, it also includes includes the product automation business. The product automation business, by the nature of the business, is a lower margin business, but has no capital intensity at all. So if you think of our services business, I think our managed services business, the services EBIT has grown very well. Obviously, it cannot match the EBIT percentages of the cash management business, which we have been running for the last 20 years. But I think it's a fairly healthy return. I think we are able to generate good return for the capital we're deploying.
Okay, right. So it's like it's becoming a necessity part of the business. That providing managed services become a kind of necessity when you go to the banks for the business.
I mean, it's more than necessary. I think it's a large TAM. It's a large TAM which you can win with. You can do. It's about getting more wallet share. If a bank is spending 100 rupees on different services and you are only operating in a 30, if you think you build the capability to offer them the remainder, you want to do that, right? Any enterprise B2B company would want to do more and more with the same customer. So if you think of most of our large banks, 20 years ago, we did maybe only retail cash management. Then we moved to ATM cash management. Then we moved to cash in transit. Then we moved to automation. In the last 5 years, we moved to BLA as a service. And now in the last 2 years, we have started doing remote monitoring services. So our goal will remain to grow with the BFSI sector, which is banks and NBFCs, and offering them new services. So I think more than necessity is about expanding the TAM for us and the opportunity for us to grow.
Okay. And regarding the cash on the books, do you think that the company is generating enough internal accruals so dividend payout will be a good option, considering the capex cycle is behind us, high capex cycle?
So in past, you will see that we have given a 25% of the dividend. And in last 2 years, as I told that 420 crore rupees we have spent for the capex, growth capex. We have not taken any loan, and a fairly good amount is sitting on our books, around 450 crore rupees of the cash and cash equivalent, which is sitting on our books as on 31st March 2023.
Okay, right then. Thanks for the opportunity.
Thank you. I now hand the conference over to Mr. Rajiv Kaul for closing comments.
Well, thank you, Balaji, for hosting the call for us and IIFL team. Thank you to all our investors for their continued support and intensive questions. I hope that we will deliver a good year for you in the coming 9 months. And we'll talk to you at the end of H1 and the second quarter then. Thank you so much.
Thank you very much. On behalf of IIFL Securities Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.